What is an IPO? An IPO, or initial public offering, is when a company sells its shares to the general public for the first time. The shares, which were formerly owned by firm executives, are made available to the general public in exchange for cash or capital that the corporation may utilize for debt consolidation or business expansion. Once the IPO process is complete, the company is declared publicly listed, and its shares can be traded in the open market. To make their shares available to the general public, private corporations cooperate with investment banks, which involves extensive due diligence, marketing, and regulatory requirements. Companies go through an IPO because they want to raise money and get their company into the hands of more people. The idea behind an IPO is that it will give them access to more capital, which they can use to grow their business and make it more successful. Normally, the shares in an IPO are divided into three categories: one reserved for institutional investors, one for non-institutional investors, and one for retail investors. Also, shares are sold in lots and not individually. Procedure of an IPO. The first step in this process is when a company decides that it wants to go public. This involves creating a plan for how much money they want to raise, as well as what type of structure they want for their company's governance structure. Then comes the actual process of going public. Step 1. Hiring of an underwriter or investment bank. To start the initial public offering process, the company will take the help of financial experts, like investment banks. The underwriters assure the company about the capital being raised and act as intermediaries between the company and its investors. Step 2. Registration for IPO. This IPO step involves the preparation of a registration statement along with the draft prospectus, also known as Red Herring Prospectus, RHP. Submission of RHP is mandatory, as per the Companies Act. This document comprises all the compulsory disclosures as per the SEBI and Companies Act. What is Red Herring Prospectus, RHP? A red herring prospectus, also known as offer document, has to be filed by a company with SEBI while raising money through an initial public offering. This document is crucial for investors as it provides detailed information about the company's operations, promoters, financials, the objective of raising funds through IPO, etc. It also explains how the company aims to use the money that will be raised, the possible risks for investors, etc. How to access Red Herring Prospectus? Investors can access a company's Red Herring Prospectus on various platforms, as mentioned below. 1. The official website of SEBI. We can access the website at https://www.sebi.gov.in/. Then visit the filings page in website and select public issues. Here, an investor can find the draft RHPs along with offer documents of all upcoming IPOs. 2. An issuing company is required to make a public announcement of IPO via at least one newspaper once it has submitted the RHP to SEBI. The newspaper can be a Hindi, English, or regional language one. 3. Stock exchange websites. 4. Select merchant banker sites. 5. National Stock Exchange, NSE, website. 6. Bombay Stock Exchange, BSE, website. Step 3. Verification by SEBI. Market regulator, SEBI then verifies the disclosure of facts by the company. If the application is approved, the company can announce a date for its IPO. Step 4. Making an application to the stock exchange. The company now has to make an application to the stock exchange for floating its initial issue. Step 5. Advertising. Over a period of 2 weeks, the executives and staff of the company will advertise the impending IPO across the country. This is basically a marketing and advertising tactic to attract potential investors. Key highlights of the company are shared with various people, including business analysts and fund managers. Step 6. Pricing of IPO. Generally, there are two methods for pricing shares of a company. First one is fixed price method. In this method, the underwriter and company work together to fix a price for their shares. Book building method. In a book built IPO, the company provides a price range. The highest price is known as the cap price, while the lowest price is called the floor price. The issue price of the IPO comes during the bidding and book building process. This is called the cutoff price. It is decided based on the bids received. Only bidders who quoted higher than or equal to this price can get an allotment of shares. In the book building process, bids are placed within a price range and finally a price is fixed. All of the bids at the fixed price and above get shares. Step 7. Allotment of shares. Once the IPO price is finalized, the company along with the underwriters will determine the number of shares to be allotted to each investor. In the case of oversubscription, partial allotments will be made. The IPO stocks are usually allotted to the bidders within 10 working days of the last bidding date.